It's funny. Usually when we look at like a medical diagnosis, there's this strict expectation of precision, right? You break your arm, the x-ray shows this jagged white line across the bone, and the doctor just points at it and says, yep, there's the fracture, here's the cast. It's binary. It's very simple.
Oh, absolutely. It's comforting, frankly. The variables are completely isolated. You categorize the problem, and the patient, or the market, I guess, in this context, can just react based on undeniable physical evidence.
Right, exactly. But then you step into the world of corporate earnings reports, specifically legacy omnichannel retail, and suddenly that diagnostic x-ray machine looks like it's just generating abstract art. The signals get totally tangled up with the noise.
Oh, man, they really do. It's a mess.
So picture this scenario for a second. Target Corporation drops their Q1 2026 earnings, and they just completely shatter expectations. I mean, net sales are up across the board. Foot traffic is actually accelerating, which is wild right now. They're dropping these wildly successful cultural collaborations, with physical lines of people wrapping around suburban strip malls before the sun is even up. So the top line momentum is just undeniable. And yet the second those numbers hit the wire, the stock price instantly drops nearly 5% before the market even officially opens.
Right. Which is, that's the textbook definition of diagnostic muddy waters right there. Because to interpret a pre-market sell-off of that magnitude, especially in the face of a top-line beat, you have to peel back the layers of that gross revenue.
Yeah.
You really have to interrogate the margin profile, the operating leverage, and, the hidden unit economics of running a multi-billion-dollar physical and digital retail ecosystem, all while sitting in an incredibly fragile macroeconomic environment.
Okay, let's unpack this, because that is exactly our mission for this deep dive into the May 2026 Target Corporation 8K filing and their Q1 Earnings Call Transcript. We're going to explore the underlying mechanics of how a massive legacy retailer tries to balance foundational infrastructure investments against shifting consumer elasticity, all while dealing with the relentless and, frankly, often contradictory pressures from Wall Street.
It's a tightrope walk, for sure.
It really is. Because on paper, right, the top line reads like a victory lap. Target reported net sales of $25.4 billion for the first quarter. That's a 6.7% year-over-year increase. And it easily eclipsed the Wall Street consensus forecast, which was sitting at $24.66 billion. So they beat it by a comfortable margin.
And, beyond just the absolute dollar value, the actual composition of that revenue is what really fueled the initial optimism. Comparable sales grew by 5.6%, but the metric that truly dictates the fundamental health of a brick-and-mortar operation, the real heartbeat, is the traffic footprint.
The actual foot traffic.
Exactly. And comparable traffic grew by 4.4% against Q1 of 2025. You have to understand, in the current retail landscape, where revenue growth over the past several quarters has been heavily artificially inflated by aggressive pricing actions.
It's just inflation, basically.
Right, lingering inflation. Driving actual physical footfalls, getting humans into the store is a completely different caliber of success.
Yeah, because if a retailer only grows sales by, raising the price of a gallon of milk or a bottle of Tide by 20%, the revenue curve looks fantastic. But the underlying volume, the actual tonnage of product leaving the store, is stagnating or even shrinking. But Target's 4.4% traffic growth means physically more humans are choosing to use their free time to drive to a store, or they're intentionally bypassing the Amazon app to open the Target app.
Exactly. And CFO Jim Lee really emphasized that this wasn't just isolated to, one viral product category or one fluke event. The top-line strength was remarkably broad-based across different merchandise divisions and even different income cohorts.
Right. And that broad-based penetration is critical. But I feel like this is exactly where the narrative starts to fracture, right? Where the financial diagnostic gets super complicated. We have to look at the earnings per share.
Oh, boy. Yes. The EPS.
So Target reported a GAAP EPS of $1.71. But here is the massive wrinkle. That GAAP figure is actually 24% lower than the prior year.
Right.
But simultaneously, their adjusted EPS was also $1.71. Which represents a 32% increase over the prior year. To reconcile those two totally diverging data points, we have to look backward at a very specific balance sheet anomaly from 2025.
Yeah, we have to talk about the credit card interchange fee settlement. So in Q1 of 2025, Target logged this massive $593 million pre-tax gain, which comes out to roughly $441 million after tax.
Wow.
And that stemmed from this long-running antitrust litigation against the major payment networks. So basically, last year's GAAP EPS was just artificially bloated by this one-time cash windfall that had absolutely nothing to do with selling, consumer packaged goods or apparel.
Nothing to do with the retail at all.
Exactly. I mean, interchange fees, the merchant discount rates that retailers are just forced to pay for the privilege of accepting credit cards, they've been a huge source of margin compression for decades. So the settlement injected this substantial lump sum into Target's Q1 2025 operating income. But when institutional investors look at a company, they strip out those non-recurring events to calculate normalized earnings power.
Right. They want to see the actual retail engine.
Exactly. And when you apply that adjusted lens and you pull the settlement out of the base year, Target's actual core operational profit grew by a staggering 32% this year.
32%,
Mhm.
which just demonstrates incredible operating leverage on the merchandise itself. And we actually see that reflected directly in their gross margin rate,
Right.
which improved 80 basis points to 29.0%. The transcript attributes that expansion to a few things: optimized supply chain productivity, a lower cadence of promotional markdowns so they aren't having to discount as much, and an expanding mix of non-merchandise revenues. So structurally, the core retail engine is operating with much greater efficiency. So we have to return to the central paradox here. If traffic is up 4.4%, core profit is up 32%, why did Wall Street execute a 4.9% sell-off at the opening bell, driving the stock all the way down to $121.01?
Because the market fixated entirely on one line item, the SG&A line.
Selling, general, and administrative expenses.
Exactly. Target's SG&A expense rate deleveraged, rising to 21.9% of total sales. And even when you compare it to the adjusted SG&A from last year, which normalizes for that credit card settlement we just talked about, the rate still increased by 20 basis points. And the absolute dollar amount allocated to SG&A escalated by 7%.
7%. That's a big jump.
It is. And in an environment where institutional capital is just brutally punishing any perceived inefficiency or bloat, a 7% spike in the sheer cost of running the business triggered immediate algorithmic and fundamental selling.
Okay, but I want to apply some critical pushback here because I think Wall Street gets this wrong sometimes. Think about it like a high-end restaurant, right? If I manage a restaurant and I increase my table turns by 4.4%, the sheer volume of extra customers is going to require me to hire an extra sous chef. I have to schedule more bussers. I have to increase my linen laundering budget. My operating expenses will absolutely rise.
Of course.
But as long as the incremental gross profit from those extra meals is higher than the incremental labor cost, my restaurant is healthier, right? So Wall Street is penalizing Target for the 7% increase in SG&A, but you cannot physically process a 4.4% increase in omnichannel traffic without deploying more capital into store labor, fulfillment networks, and just maintaining the physical building.
No, you're 100% right. You're hitting on the fundamental ideological battle that's currently playing out across the entire consumer discretionary sector. The buy side wants completely contradictory outcomes. Analysts demand relentless market share acquisition and volume growth, right? But they simultaneously demand severe cost containment to protect near-term free cash flow. It's impossible. And Target's executive suite, led by CEO Michael Fidelk, they actually spent the majority of this earnings call defending a very calculated thesis. They argued that their SG&A growth is not administrative bloat, it's structural investment.
Yeah, they're actively deploying capital into elevated wage rates, they're expanding hours for the floor teams, and they're rolling out these massive technological training initiatives. And they're doing all this operating under the belief that the 4.4% traffic growth is a direct byproduct of a superior in-store experience. Like, they didn't just get lucky.
Exactly. If they constrain payroll just to satisfy some quarterly margin target, the immediate downstream effect is out-of-stock merchandise. You get unkempt aisles, you get massive friction at the point of sale. And eventually, that traffic figure inevitably goes negative.
Well, Wall Street operates on a 90-day cycle, though.
Right. They see rising wage inflation, they see macroeconomic fragility, and they fear that Target is locking in higher fixed operating costs just as the consumer might be preparing to, pull back on spending. The market is basically telling Target, hey, you are overinvesting in the customer experience relative to the risk of an impending economic contraction.
Which is such a cynical view. But if you're Target, and you're going to justify a 7% spike in operating costs to these analysts, you have to prove that your investment fundamentally alters consumer behavior and drives outsized returns.
Yeah.
Right? And I think Cara Sylvester's entire merchandising playbook is the justification for that exact spend.
Cara Sylvester, the CMO.
Yeah.
Yeah, her strategy right now is remarkably targeted. They are focusing the vast majority of their capital allocation on one highly specific psychographic cohort.
The busy family.
The busy family. She stated explicitly that this demographic already commands a disproportionate share of Target's wallet. But more importantly, The strategic pillars aimed at this specific group are modeled to drive roughly 3/4 of their projected future growth.
3/4. That is massive concentration. But analyzing how they actually operationalize that busy family strategy reveals, honestly, a masterful application of lifetime value modeling. LTV. Like, take their baby and kids initiative, for example.
This is fascinating.
Yeah, Sylvester detailed this sweeping category overhaul. They're introducing 2,000 new items starting at just a single dollar. But they didn't just dump cheap product on the shelves. They paired that value proposition with a crazy aggressive service model. They're rolling out what they call baby concierges across 200 test locations.
And that specific move drove a 5 percentage point acceleration in baby comparable sales late in the quarter.
Which is huge. But let's look at the customer acquisition cost of a baby concierge.
Yeah.
Dedicating a fully trained employee just to walk the floor and advise anxious, sleep-deprived parents on stroller safety ratings or, formula ingredients. That is an incredibly high SG&A burden per store. You are paying an hourly wage for someone who might just talk to one parent for 45 minutes.
Right. But the baby category is the ultimate Trojan horse of retail. If you absorb the high acquisition cost of providing that highly personalized service, and you win a millennial parent's trust during that extremely high-stress transitional phase of life, you don't just capture their diaper budget.
No, you capture the entire household P&L.
Exactly. The baby category forces frequency. Once a consumer develops a habitual weekly cadence for baby essentials, the friction to consolidate all their other purchases just dissipates. The parent consulting with the baby concierge is inevitably pushing their cart through the grocery aisles, they're wandering into the apparel section, they're looking at home goods. Target is willingly taking a localized hit on store labor margins to dramatically expand the lifetime value of that specific household.
Which transitions seamlessly into their grocery strategy.
Okay.
Because historically, for a big box department store, grocery basically functions as a convenience play. It's an afterthought for a shopper who is already in the building buying a sweater. Target is aggressively attempting to re-engineer that psychology with their Food Forward initiative.
Or what you?
They injected 3,000 brand new food SKUs into their assortment in the first quarter alone. And the sales velocity on those new items outpaced the legacy assortment by 50%.
50% faster sell-through. That's wild.
Right. Sylvester highlighted that they are actively resetting nearly half of their center store dry grocery footprint.
Yeah.
And there was one specific operational detail that really stood out to me here. The complete elimination of certified synthetic colors from their entire cereal portfolio.
Yeah, that synthetic color removal is actually a brilliant proxy for understanding their broader private label strategy. Executing that kind of pivot requires entirely re-architecting their supply chain.
I can't even imagine.
It's massive. You're suddenly sourcing natural alternatives, right? Like beet juice or turmeric extracts. You have to reformulate flavor profiles so it doesn't taste like beets. And you have to manage the shortened shelf life implications of natural ingredients. It is logistically daunting.
Yep.
But it perfectly aligns with the psychographic profile of that busy family demographic.
Mm-hmm.
These are consumers who are navigating intense time poverty, they are exhausted, yet they remain highly selective about clean label ingredients for their kids.
Well, and over 70% of their guest base actively shops the health and wellness category. So
Right.
by introducing 1,500 new items to that specific vertical and refreshing 40% of the assortment, which resulted in double-digit Q1 sales growth. By the way, Target is really weaponizing their own brands. They're capturing the premium margin profile that's associated with natural and organic foods, while simultaneously undercutting the pricing of legacy national CPG brands. It's a squeeze play.
It is. But here's where it gets really interesting, though, because it's not just about capturing the routine, mundane grocery run. CEO Michael Fidelk remarked that they are currently executing the most substantial transformation to their product assortment and really their entire merchandising philosophy in a decade.
A decade, yeah.
They are actively trying to bridge the gap between being a high-frequency utility retailer, where you go for toilet paper, and a destination for discretionary discovery, where you go for fun.
Right.
You see this in the rollout of their Threshold Shop in Shops, which is going to overhaul 75% of their decorative accessories, and the deployment of the Target Beauty Studio across 600 locations this fall, complete with specialized fixtures and dedicated beauty consultants.
And again, we circle back to the SG&A debate. A dedicated beauty consultant mirrors the operating model of a specialty retailer like Sephora or Ulta. Target is intentionally blurring the lines. They're absorbing specialty retail labor costs to elevate the mass market experience. But in the most aggressive manifestation of this strategy is their reliance on what we could call engineered serendipity. They're meticulously orchestrating cultural moments to manufacture raw, undeniable foot traffic.
The drop model.
The drops.
Yeah. Q1 featured highly publicized, limited-duration collaborations with brands like Parachute and Roller Rabbit. But the defining event, without a doubt, was the cross-category Pokémon partnership. Sylvester noted that the assortment ranged from casual K-pop tops all the way to highly structured boot tops jackets.
That boot tops jacket.
I know. They also executed a K-pop BTS launch. Fidelk specifically mentioned on the call observing physical lines of people outside of Target locations before the doors even opened on 3 separate occasions so far this year.
Just let that sink in for a second. We need to break down the unit economics of a drop because it operates completely contrary to traditional retail logic. A standard retailer wants a high-performing SKU to remain in stock perpetually, generating steady, predictable cash flow. But the drop model relies on engineered scarcity.
Exactly. You intentionally undersupply the market with a culturally relevant asset. The margin generated from selling out of a limited run of Pokemon jackets is totally secondary. The primary objective is the halo effect.
Right, because the drop functions as top-of-funnel marketing. It generates organic, peer-to-peer social media impressions that perform far better than any paid digital ad you could buy. But more importantly, it forces an incredibly diverse demographic cross-section into the physical store ecosystem. When a consumer arrives at dawn to secure a limited edition collaboration, the attach rate, the likelihood of them purchasing additional high-margin discretionary items or even everyday essentials on their way to the register spikes dramatically.
They came for Pokemon, but they leave with paper towels and a threshold lamp.
Exactly. But consider the psychological barbell they are asking the consumer to balance here. At the exact same moment they are driving premium boutique-level hype with apparel collaborations, they are reporting double-digit comparable growth in their Fun 101 category.
Right, the toy division.
Which is heavily anchored by toys priced at $5 and $10. And I have to push back here, or at least question the sustainability of straddling both extremes. Can a single retail footprint simultaneously cultivate the aura of an exclusive streetwear boutique and a deep discount dollar store without completely fracturing its brand identity?
I think it actually just reflects the fractured reality of the modern consumer's balance sheet right now. In an inflationary environment, consumer behavior bifurcates. A middle-class household will ruthlessly trade down on commodities. They're demanding the $5 toy and the cheaper private label cereal to protect their core grocery budget, but they will selectively trade up to secure a highly coveted, culturally relevant status item.
Ah, okay.
Target's strategy acknowledges that consumers refuse to trade style for affordability. By positioning the heavily discounted essential literally mere aisles away from the aspirational collaboration, they capture the entirety of that polarized spending behavior.
That's a great point. But executing that barbell strategy requires extraordinary logistical precision. Orchestrating a localized, high-demand cultural drop while concurrently flowing 3,000 new food items into the supply chain without causing massive stockouts or totally backing up the backrooms. That's an incredibly complex physics problem. And this requires diving into the physical infrastructure of the company.
Yes. Chief Operating Officer Lisa Roth provided a really comprehensive look at this underlying architecture on the call, the physical and digital supply chain, and the capital expenditures funding it. Target just inaugurated their 2,000th store, and they have plans to launch 30 new locations this year and execute 100 full-scale remodels, all supported by a massive $5 billion CapEx budget. But the architectural philosophy of these new locations is what really stands out to me. They are deploying layouts ranging from 125,000 to 150,000 square feet.
Which seems completely counterintuitive at first glance. The broader retail industry has spent the last decade shrinking physical footprints to offset the migration to e-commerce. Why on earth is Target actively expanding its square footage?
Because they are aggressively pursuing a stores as hubs model. They currently fulfill over 95% of their total sales volume, including all their digital orders, directly from the store floor.
95%, that is unbelievable.
It is. So these new 150,000 square foot facilities are not merely expansive showrooms for customers. They are highly localized micro-fulfillment centers that just happen to operate under the guise of a traditional store.
And the unit economics of last-mile delivery totally validate this approach. Centralized fulfillment, like the Amazon model, requires shipping individual parcels across state lines, which heavily degrades gross margins. Target utilizes the physical store as a forward-deployed inventory node. When a customer places an order, the picking, the packing, and the dispatching occur mere miles from the final destination.
Exactly.
And this architecture directly facilitated the 27% growth they achieved in same-day delivery powered by Target Circle 360.
Right, but you have to admit, turning a store into a warehouse introduces massive inventory management challenges.
Absolutely, the clutter.
Yes, which Roth addressed by highlighting their new receive center in Houston. This facility is engineered to process 25 million cartons annually. Its specific mandate is to hold long lead time seasonal import inventory upstream in the supply chain.
And what's fascinating here is how upstreaming inventory fundamentally alters the working capital dynamics at the store level. Historically, retailers pushed inventory down to the stores as quickly as physically possible to get it off their books. But forcing a store in, say, Ohio to hold Halloween merchandise in its back room in July clogs the arteries of the building.
It's terrible for morale, too.
Oh, it creates massive negative operating leverage because employees spend hours just navigating cluttered back rooms, moving pallets around rather than serving customers. By holding 25 million cartons in a centralized holding pattern in Houston, Target can deploy inventory to specific stores dynamically, reacting to real-time, localized sell-through rates.
Yes, and this upstream flexibility is augmenting their inventory turns, which increased by 10%. They are generating more revenue per dollar of inventory deployed. Furthermore, they are layering advanced technology over this physical infrastructure. They're deploying AI-driven demand forecasting models to mitigate supply chain volatility and upgrading the proprietary My Device handhelds used by all the floor teams.
So they're arming their 300,000 team members with better tech.
Exactly. Yet, while they optimize the physical movement of pallets and cartons, Target is simultaneously constructing an entirely asset-light, high-margin ecosystem in the digital background. Target reported that GMV gross merchandise volume for their Target Plus third-party marketplace surged by nearly 60%.
60%.
And concurrently, Roundel, their digital advertising division, delivered robust growth.
And this introduces a fascinating evolution in corporate identity. Target is actively operating a massive retail media network. As third-party cookies depreciate across the web and digital acquisition costs soar on platforms like Meta, closed-loop attribution becomes the absolute holy grail for advertisers.
Oh, without a doubt.
Roundel allows CPG brands to leverage Target's proprietary first-party transactional data to serve highly targeted advertisements. The brand can track exactly how a digital banner ad for, say, shampoo translated into a physical point-of-sale transaction at a register in real time.
And the margin profile of a retail media network is structurally entirely different from selling groceries. Grocery margins hover in the low single digits. It's a volume game. Digital advertising margins can easily exceed 70%.
Wow.
So when you amalgamate Roundel's ad revenue, the commission fees generated by the Target Plus third-party marketplace, and the recurring subscription revenue from Target Circle 360, you realize that Target is cultivating a digital tech and logistics platform layered almost invisibly over their traditional retail operations.
They're essentially building a fortified balance sheet. They're diversifying their profit pools to insulate the core business from potential macroeconomic shocks. And honestly, that undercurrent of macroeconomic anxiety heavily dominated the analyst Q&A session.
It really did.
CFO Jim Lee navigated the forward guidance section with a highly calibrated blend of optimism and, frankly, defensive posturing. Target actually raised their full-year net sales growth guidance to roughly 4%, so a 2 percentage point upward revision. They also indicated that EPS would likely land at the high end of their previously established $7.50 to $8.50 range.
However, Lee explicitly cataloged the looming headwinds. He didn't sugarcoat it. He acknowledged that consumer sentiment is exhibiting sustained sequential decline. The consumer is getting tired. He also introduced a crucial caveat regarding the Q1 performance. The substantial top-line beat was likely temporarily amplified by a shift in the timing of higher tax refunds.
Ah, so a liquidity injection that won't repeat.
Right. It creates a short-term boost that will inevitably evaporate as the year progresses. Furthermore, they face a formidable comparative hurdle in Q2 as they must lap the highly lucrative product cycle of last year's Nintendo Switch 2 launch, which instantly creates a 200 basis point headwind.
Just from one console launch. But the mechanics of how they structured that guidance are telling. Raising top-line revenue projections while maintaining the existing boundaries for bottom-line EPS is a classic exercise in preserving optionality. Lee is surveying the back half of the year. He's modeling out volatile variables like fluctuating ocean freight rates and the totally unpredictable timing of shrink recognition, meaning theft and loss, and he's opting to underpromise.
Exactly. He is managing institutional expectations. He's ensuring the executive team has the necessary margin of error to continue funding their CapEx and SG&A initiatives, even if consumer discretionary spending decelerates sharply.
Which naturally led the analysts to probe the exact composition of the Q1 outperformance. They were trying to isolate Target's strategic execution from broader market tailwinds or, shifting cultural narratives. Michael Lasser from UBS directed a highly specific line of questioning at CEO Michael Fidelk, asking whether Target was observing a return of, quote, longer lost guests, and inquiring directly if, quote, boycotts are diminishing.
Right. And Fidelk's response to that was just a masterclass in executive discipline. He completely bypassed the cultural and political subtext of the question. He anchored his entire response purely in the empirical data, reiterating the broad-based nature of the 4.4% traffic acceleration and emphasizing how consumers across all cohorts were responding favorably to the newly introduced merchandising assortments.
He just pointed straight back at the scoreboard.
Yes, he utilized the quantitative metrics to demonstrate that the underlying operational engine is functioning efficiently regardless of external noise. And from a fiduciary standpoint, maintaining strict adherence to the fundamental metrics is the only viable path for a CEO. It forces the analytical community to evaluate the company based on its cash flows, its supply chain velocity, and its market share capture rather than the subjective cultural barometers.
So what does this all mean? We are presented with a somewhat paradoxical narrative here. The executive suite highlights resilient consumer behavior, pointing to the 4.4% traffic growth. Yet, the financial architecture of their forward guidance is reinforced with heavy sandbags, anticipating a potential storm. Are they building the ship as if a storm is coming tomorrow? I mean, are internal predictive models signaling an imminent fracture in consumer spending that management is just hesitant to articulate publicly? Or is this merely the inherent risk aversion expected of a seasoned CFO?
Honestly, the reality likely exists at the intersection of those two theories. Retailers possess unparalleled real-time visibility into the consumer's balance sheet. If a household downgrades from a premium laundry detergent to a private label alternative, or they defer an apparel purchase while maintaining their weekly grocery cadence, Target's data models register that elasticity instantly.
In real time.
Yes. Management recognizes that the consumer is currently employed in transacting, sure, but they are equally aware that aggregate credit card balances are inflating nationwide and savings rates are compressing. A prudent CFO constructs a financial model resilient enough to withstand the bear case scenario, while providing the CEO with the operational runway to pursue the bull case revenue targets.
Let's synthesize the entirety of this deep dive. We initiated the analysis with a core paradox. Target posts a substantial Q1 revenue beat, traffic surges, yet institutional investors execute a massive sell-off because SG&A expanded by 7%. But by interrogating the operational mechanics beneath that headline figure, we uncovered the exact strategic yield of that increased expenditure.
We did. That SG&A line item isn't just wasted money. It is actively funding a radical reconstruction of their merchandising philosophy. It capitalizes the deployment of those baby concierges. It underwrites the insanely complex supply chain necessary to eliminate synthetic ingredients from their grocery portfolio. And it enables the logistical precision required to execute culturally resonant drops with brands like Pokémon.
Without causing a meltdown in the background.
Exactly. It supports the operation of 150,000 square foot hybrid facilities acting as localized micro-fulfillment hubs, backed by an upstream supply chain capable of dynamically allocating 25 million cartons based on AI demand forecasting.
So the next time you find yourself navigating a Target location, whether you are executing a routine grocery run for a $5 private label staple or arriving early to secure a limited edition collaboration, and you observe the optimized product placement, or you witness a team member finalizing a same-day Circle 360 order, I really want you to consider the invisible architecture supporting that moment. You are witnessing the physical manifestation of billions of dollars in allocated CapEx, rigorous demographic targeting, and highly contested corporate strategy operating in real time.
It really is an incredibly sophisticated logistical symphony, and it's engineered to present as a frictionless, highly curated shopping experience. Every variable, from the formulation of the cereal to the square footage of the backroom, must synchronize perfectly to cultivate consumer loyalty while generating sufficient yield to placate the capital markets.
But I want to leave you with one final provocative concept to evaluate based on the data. Buried deep within the financial disclosures is a historical fact that management frequently highlights. Target is classified as a dividend aristocrat.
Which is a huge badge of honor in finance.
Right. They've consistently increased their dividend payout for 55 consecutive years, currently offering a yield of roughly 3.58%. That classification cements them as a highly stable, predictable pillar of legacy brick-and-mortar retail. However, evaluate that legacy identity against the explosive growth trajectory of their non-merchandise initiatives. Target Plus Stav, their third-party marketplace, is compounding at nearly 60%. Randell, their proprietary ad network, is capturing massive digital ad spend.
And like we discussed, the profit margins generated by facilitating digital advertising and executing third-party logistics operate on an entirely different plane than the margins generated by physically moving bananas or basic T-shirts across the supply chain.
Exactly. With those digital, asset-light, high-margin divisions scaling so rapidly, what happens if this 55-year-old physical retail institution eventually crosses a financial threshold? What happens if, a decade from now, Target generates a higher net income from monetizing digital attention and providing back-end logistics to third-party vendors than it does from selling its own physical inventory? Will the Target of 2035 even be recognizable as a traditional retailer? Or will it have quietly metamorphosed into a massive data-driven technology and logistics company that simply utilizes exceptionally well-merchandised, well-lit brick-and-mortar storefronts as customer acquisition nodes?
It's a wild thought. It forces a complete reevaluation of their valuation multiple and fundamentally challenges how we define the future parameters of omnichannel retail.
Thank you so much for joining us on this deep dive. Keep analyzing the hidden mechanics of the brands you interact with every single day. Because, as we saw today, the initial X-ray rarely reveals the true complexity of the underlying system. Until next time, stay curious.